In just under 3 hours' time, Reserve Bank Governor Gill Marcus will take the podium to deliver the results of the Monetary Policy Committee's 2.5-day meeting on interest rates. While the majority of economists don't expect a cut today, the bond and money markets are pricing in an increasing likelihood that the bank will cut, if not today, then at its next meeting in September. Joining me with his views is Sizwe Nxedlana. He's a senior economist at FNB Commercial. Sizwe, 5 out of 21 economists polled by Reuters do expect a cut, 16 don't. What side are you on?
I'm on the side that doesn't expect a cut, and the reason is that we've been basically told by the Reserve Bank Governor at the BR conference in April that, and I'm paraphrasing her, that rates are likely to remain stable for an extended period. She said that this was not an unconditional commitment. She said the things that would basically change their minds for a cut would be, amongst other things, a rand that strengthens, growth that surprises on the downside, and possibly inflation that also surprises on the downside. Now, since she's made that speech, the rand was sitting at 7.33 on average in April. It averaged about 7.63 in June. It's now back to about 7.55, 7.50 odd. At the time, they said, when they cut in March, they said that household consumption expenditure, they described it as being tenuous. It's now recovered from 1.6% in Q4 09 to 5.7%. And it seems to be sustainable given the fact that a lot of the underlying subsectors of household consumer spending are also strong. Growth is accelerated to 4.6%. And on the inflation front, even though we think that inflation is going to remain within target over the forecast period, we don't think that it's going to surprise on the downside. We think inflation bottoms in the third quarter at around 4.5%. It's very difficult with the electricity tariffs kicking in and some of the administered price increments that are kicking in to see inflation bottoming closer to 4%.
Of course, by the September meeting, we will have had a bit more clarity on the impacts of those electricity tariffs on inflation. Of course, we'll see how the whole European saga plays out a little bit more by then. And of course, we'll also see what the World Cup effects on inflation have been. So do you think there's still a chance of September for a cut, or do you think that's also out of the window at this stage?
Look, the markets are certainly pricing in a high probability of a cut in September. I think, firstly, these increasing probabilities of a cut being priced in by the markets were a function of another speech made by the governor at the Joburg Country Club about 2 weeks ago, where she came out looking a little bit bearish on the outlook for the global economy and the potential impact that could have on the South African economy. And if you look at the latest World Economic Outlook update of the IMF, they've in fact upped the global growth forecast, but they've also increased the terms or the conditions of the downside risk. So they see more risk, but that spillover hasn't in fact occurred. So we share the view that the global economy is fragile, but so far so good. It'll probably slow down in the second half of the year, but it is growing and recovering gradually. So that recovery is intact. So coming back to the South African Reserve Bank, we think that in September, it's highly unlikely that we would have seen a substantial deterioration in global growth, and it's highly unlikely that we would have seen inflation possibly surprising on the downside by then. So we would stick to the view of monetary policy being kept stable for an extended period.
Let's go back to the rand, because you said it's weakened slightly since April. It was around 7.20, 7.30 in April, now around 7.50, 7.60. Some would argue that's still a bit too strong. We had the OECD coming out this week saying we should take measures to try and weaken this rand because we're not competitive internationally with our exports. We've also had unions calling for a weaker rand, and lots of people in the manufacturing industry also looking for the rand to weaken. Do you think by cutting interest rates now we could at least try and get the rand to soften slightly?
No, I don't think cutting interest rates will lead to a depreciation of the exchange rate. That link is I mean, in the textbooks, they'll say higher interest rate differentials lead to a stronger rand, and therefore reducing the interest rate differential in South Africa will lead to a weakening of the rand. But if you look at portfolio inflows, a lot of them the majority are not in fixed income assets. The majority are in portfolio assets which chase growth.
Chasing growth.
So what could happen is that reducing interest rates could in fact lead to even more portfolio inflows seeking equity exposure in South Africa, and therefore lead to further appreciation of the exchange rate, especially if risk aversion, the stress tests that are coming from European banks, in the global economy, the growth profile remains intact and therefore risk aversion subsides, you could see even more portfolio inflows because of a rate cut.
Of course, that's what we saw last year, really, with those 550 basis points of cuts. It really pushed the growth story for South Africa, didn't it?
Yes.
Just looking at these wage increases, and of course we heard today that the public sector workers could also be going on strike from next Thursday. They've served a notice for that. They're looking for an 8.6% wage hike against 6.5%, so not quite as high as the Eskom increases that were demanded perhaps for some of the other unions, but still 8.6%, that's twice where we see inflation at the moment.
I'm starting to worry. I wasn't worried before about the wage increments because what you tend to find in South Africa is that wage increments tend to be backward looking. And so what we saw currently was that these double-digit wage increments were a function of what they called occupation-specific dispensation. So there were some public sector workers and some public sector professions that were having their wages upwardly adjusted. For example, shocking situations where doctors with 6-year degrees or some even specialists earning below 200,000 rands per annum, whereas you want to attract those skills into the public sector, into the health service, and therefore those wages were increased and adjusted upwards to more market-related salaries. And we're told that that's a one-shot sort of adjustment. What's worrying now is it's starting to become a trend, and if it does in fact become a trend, then it could start becoming problematic for inflation and or the increase in employment. But to the extent that it remains, as the government has promised us, that it's just a one-shot adjustment, then I don't think that it should be too much of a problem.
Okay, just quickly, from the perspective of a banker, of course you work for a banking group, do you think your customers should be confident enough with interest rates where they are? They don't need another cut, and we can of course have low interest rates for longer if we don't have a cut.
I think that's something that's definitely our base case scenario, that even if we don't see a cut now and or September, which is what our view is, interest rates do, or monetary policy in South Africa does remain stimulatory and accommodative, because if you look, for example, since we started inflation targeting, the average real interest rate now remain low for up until I think the end of the forecast period, even without an interest rate cut. So monetary policy, I would say, is accommodative at present, which is definitely something good for the consumer side of the economy.
So we're going to have to leave it there. Thank you.